Hey, welcome everyone to the special edition of Options Brew TV with Mark Phillips of Harvested Financial. So this is our market shot. We usually do this on Thursday, but I think we had a little special idea today. We're going to talk about what's been going on in the market with predominantly GameStop, but there's some other ones. GameStop, sorry. GME is the ticker. And short squeeze. So Mark and I are going to discuss a little bit from the side of understanding what's going on in the market and how these things occur and some of the ramifications potentially of what can happen. Mark, welcome as always. I think this is going to be some interesting stuff for the folks, right?
Absolutely, Lex. I'm really looking forward to talking about this one. It seems like it's all anyone wants to talk about in the markets these days.
Yeah. Well, I mean, everyone's read the newspaper, so let's just set it up. What's going on here? So we've had the stock. And it's GME. What's the name of this stock? GameStop?
GameStop Corporation.
Okay, and it's a bricks and mortar company that exists in the gaming world, right? And now everything's online. You can download things. So the concept here was, wow, this company, how can it be around much longer unless it changes its business model? Because it's a bricks and mortar and everyone can download this stuff. And why do we need it, right?
Exactly. It was where me and my friends used to go and trade our Nintendo 64 cartridges, and you get all the new games and whatnot there. But no one's going to the mall these days. It's both a pandemic play, but it's also, like you say, it's the total digital delivery of video game systems right now that everyone's like, this stock's going into the ground, and you got a lot of big hedge funds that were betting against it.
Right. So that's an important point. So the next step of this whole explanation of the short squeeze and how this happened is that someone like a hedge fund decided, I don't believe in this company. And and we're not saying anything nefarious was going on with the company at all. They just didn't believe in the fundamentals of the business model and thought they would sell it short so that they can take advantage of the stock going lower. Now let's you and I just explain short
selling. If you are a long holder of stock, you buy a share of stock, 100 shares of GameStop. When you sell that, you would sell that long. You're closing out your position. That's sort of the standard way that you buy first and then you sell second.
Mm-hmm.
I like to think of short selling as the opposite, that you're doing the exact same mechanics, just in the reverse order. That instead of buying the stock first, you're actually going to sell the stock first,
right?
Because you believe that its value will go down in the future.
Right.
So you sell the stock today in the hopes that in the future you will buy that back for a lesser price. And in order to do that, you need to borrow those shares from someone.
Right.
So you can't just go out and sell the stock. You need to be able to deliver that stock to the person that has bought that. So you need to go borrow those shares from someone. Mm-hmm. And so there's a whole deep arcane market of stock loan and stock borrows and acquiring those different shares, whether brokers are lending them out, whether long holders are lending them out. So it's a pretty complicated world in there if you want to get involved in some of that short selling.
Yeah, and then it from our years back on the floor, there were hard to borrows, and what that meant was that there was a predominance of short selling. And remember what Mark said, you have to borrow the shares from someone who actually has them. And if you run out of people who have them, it becomes hard to borrow, right? So important point to know, those shorts, it can become very difficult to borrow those shares to sell them. And then the next phase of this equation, part 3 here, when shorts are no longer available, bad things can happen. So that's the next phase of this particular story, right? So these people, let me just say, the people who shorted these things, and it could have been hedge funds, it could have been whomever, right? Who could have access to the lending program here. They are saying that they are going to sell these first, as Mark said, buy them back at a future time, hopefully at a lower price, and make the difference, right? If not, and the stock goes the bad way up against these short sellers, they either have to cover them at a loss or post more money to margin the position. Does that all make sense to you as well, Mark?
Yep, exactly. That's a perfect description of it.
Okay.
And, one thing I'll add in there is that the shorts are paying an interest rate to borrow those shares. Mm-hmm. So in the same way that you would be borrowing money, you're paying interest on that. And one of the mechanisms that the stock loan market uses to price sort of that hard to borrow-ness that you were talking about is the interest rate. So are you paying, 2% to borrow these shares? Those are generally the relatively available shares. But when it starts to get scarce, that interest rate's going to skyrocket, and you're going to be paying an increasingly high interest rate to stay short. And so there's a lot of factors that are really starting to squeeze you more and more as it gets short.
Correct. Good point there. Excellent. Yep. Okay. So now what's the next phase of this? What happened next? So we have a short selling institution, let's say, or others who are betting on the price going down. Then what happened? We had this Reddit community who decided to say, you know what, we don't believe in that, and we're gonna, put our money where our mouth is and buy maybe out of the money calls or whatever they did. Is that right?
Exactly. So the short squeeze is nothing necessarily new. This is just taking on a whole different flavor of it, but it's the idea of shorts tend to have relatively weaker hands because of some of the things we've just discussed. As the stock goes up, there's potentially unlimited upside. They need to post more margin. They're going to be losing on that position, so they potentially need to buy it in and close it down and whatnot. So if you can identify a stock that has a particularly high short interest, then there are potentially a lot of people on the other side of that trade that might need to buy to cover if the stock goes up. So if that stock finds itself in a situation where there's increased buying activity, those shorts are going to start to cover increasingly quickly, and it creates a positive feedback cycle where one short buys it in, and then the price goes up, and then another short has to buy it in. And so you have this sort of compounding effect where the shorts increasingly are going to get squeezed there.
Right. So you get the snowball effect when this happens. Now, in this particular case, though, again, we're not commenting on right, wrong, and different or any of that stuff. We're just telling you what happened. So I think the Wall Street bets community, I think it was where it started. That community believed otherwise. They started buying, I think, out of the money calls, and maybe some stock as well. Exactly to your point, that starts pushing the stock price higher. And the shorts are continually getting squeezed. This is the reason for the squeeze, meaning that I've got to deliver these shares. It's going against me. I'm losing money. I need more money to hold this position, et cetera. So that snowballing effect just kind of runs itself on the line. Now, this community had 3 million people strong. And that doesn't sound like a lot, I guess, for some of these big, billion-dollar hedge funds. But then all of a sudden you might get a little institutional jumping on the momentum train higher who believe otherwise from the short side. And now you've got institutions plus retail, and you've got this movement of trying to get long the stock and squeezing the shorts out and moving this price in a quick fashion. Is that, what else can we add to that?
Yeah, I'll add that, I think what makes this one particularly special and has been sort of a phenomenon that we've seen over the last couple of years in the markets more and more so has been this gamma squeeze that you're talking about, where the gamma squeeze element that's almost layered on top of just the classic, long and short in the stock. When you start adding the out of the money calls to that whole mix, you add a whole nother layer that's just exacerbating and fanning the fuel on the fire here. Because like you said, that they buy the calls, the dealer then is now short a call, and they need to buy stock to hedge that. So, you have your liquidity providers that are on the other side of these options trades that then need to hedge their whole position. And so they're buying stock against that. And, in many cases, they might even be overbuying stock because they're seeing this, they might be over hedging those calls that they're selling because, they're seeing this unlimited upsize and this squeeze happening. So, it all kind of adds fuel to the fire here, and you've got the shorts buying their shorts in, the dealers buying their stock to cover their short calls, and what that does is it really creates that parabolic price action that we saw last.
And that's what we saw a lot of. So Mark and I, in our pro days, let's say when we were market makers, and when Mark refers to a dealer, you're referring to market makers, the people who make liquidity on the other sides of the markets that we as retail folks trade on. So when the whole group of folks, whomever they are buying options, there's someone selling those to them. That's typically the dealers or the market makers. We as dealers or market makers, when we did that, we'd get short calls, buy that stock back to cover it. We might not be putting in stock all the time. We might try to trade out of that into another long option, depending on edge. But in the interim, we're placing our hedge in a safe place, which is to buy a stock. That cascading effect keeps moving that stock higher. And as Mark referred to, the gamma part of it is we keep getting shorter as it goes up because we're short options and our position gets shorter. We have to keep buying more and more stock to cover that shortening position as it goes higher, right? So it's a scary position for both sides. The poor short squeeze group, they're getting crushed on that move. The dealers or market makers are trying to keep up with it and keep buying stock. And the original people who started buying calls, they're doing great, right? And they just have to know when to get out.
I was just gonna say it's like that merry-go-round though. You don't want to stay on too long. I mean, look,
Yep.
stock's down 28% today, so
Yep.
like it's a very delicate balance there.
It's called musical chairs. When the music stops, you better get in one of them, right? Get out of that position. All right. So that's kind of the gist of what's going on here. What else can we add to this, Mark? Anything else that we were going to talk about IV a little bit, right?
We were, and I think to highlight on your musical chairs point, like one of the most fundamental things that this really brings out in the markets is who are you trading with? Like that's one thing you've always got to think about when you're putting on the trade when you're buying that top ticket game stock. Well, who's going to sell it to you? And like where could it go from here? Well, if there are more buyers than sellers, no one was going to jump in front of that train last week. So I think in many ways that's where we saw this like pockets of just these air pockets where it would just go straight up because who's going to take the other side of that trade?
Right. Yes. And the market making community, there's only a handful left. Now, granted, they're very well capitalized, right? They're huge, but they have a risk parameters too. They're gonna move their quotes up and move prices up, which causes everything to go higher, volatility wise and price wise. And I had a story told to me by someone maybe a week ago, and I didn't tell you this, Mark, but the person I think sold some puts when the stock was 100, and I'm making the numbers up for now. Stock went up to 300. So the price of the stock moved up and the price of the puts moved up as well.
It's crazy.
So what's going on there? Implied volatility has just gyroscoped to the moon on these. And when you pull the calls to go up, well, guess what? The puts have to go up correspondingly because they're related to one another. And puts going up when stock's going up is like, well, how does that happen? I thought that wasn't what was supposed to happen, but it did in this massive implied volatility surge.
I'm pretty sure we saw readings over 1,000 implied volatility last week.
Which is, I don't think I've ever seen that in my life, quite honestly.
No. I mean, that's a crazy move. Like when you talk about what an implied volatility of 1,000% is, like, even just looking at like what an implied volatility of 600 is right now, which is where we're trading in this front month weekly. So like the Feb 5th expiration is 4 days from now, is trading at 596 implied vol.
Yep, that's what I'm looking at. I'm doing a little calculation now. So what do you? I think you've done this one already. What do you have for that? 250 stock price, and you said what, 600
implied vol.
Implied. So that is, by my calculation, about a daily move of $94.50.
Yep,
that's a day. That's 1 day.
Yep.
So
and we're down 82 today.
What? I'm sorry.
I was just going to say we're down 82 today, so a 600 implied vol isn't that far off.
Oh my God, this is it's unbelievable. So it's almost there, right? So the actual straddle in the front month is trading $122. We said it was about 95-ish, so it's up there for sure. Percent move is it? That's of 250, right? So that is 38% move in the stock in a day.
In a daily basis. It's crazy. Well, and I think actually, let me pull up my trade hawk. I'll do, because one of the other fun things with implied vol when it gets this high is just like how like the options become. And so this is a really interesting concept when that market makers will talk about is the likeness of options.
Yep.
Is that, and we think about both strikes, so like how close are the strikes to each other, and we think about being in the same expiration and whatnot. And so the idea of like options is they tend to be very hedgeable. They're good hedges for each other and whatnot.
Yep.
But when vol goes to this absolute extreme, everything starts looking alike. So, I'm looking at the just out of the money, this 245 call is a 62 delta, trading about $59 right now. The call that's $5 higher is, barely $1 difference in price, one delta difference.
Yep.
You go up to the 270 call, that's still trading around $52.
Right.
So,
and 56 delta, right? So it's delta hasn't changed much.
Right, exactly. So that like all these options, you go all the way up the board, and even the 400 call is trading around $27 right now. So it's like the volatility. I like to think of that as really like widening and flattening the bell curve of the distribution of outcomes. Well, if vol goes all the way up, that distribution outcomes is going to be huge. So all the options that are relatively close together right now, the grand scheme of things, those are, when ball's 600, they're all the same. You know,
Right.
this stock could be 700 tomorrow. It could be 10 tomorrow.
That's right. Yeah. One of the things we learned back in the day and that we also taught is the higher implied volatility goes, the more your delta tends toward 50 because of what you just said. I mean, with gigantic volatility, you never know what option is going to be at the money, in the money, deep in the money, out of the money. It could be all in the same day, you know, all of the above. Right.
And just to show exactly, no, that's a great point about how everything becomes a coin flip at that point.
Yep.
When I like to think in total extremes, if everything's completely out the window, well then, you know, all these options are either worth something or they're not, and it's just a coin flip at the end of the day. It's 50
right.
Delta.
Yep.
Other thing that the vol will do in terms of time. So we looked a little bit across strikes there, but you know, so say you're thinking, you know, I know doing a covered call and this sounds like a little bit absurd, but like, you know, selling at the money call, you know, expiring in 4 days, you'll collect around $60.
Mm-hmm.
If you want to go out 18 days and collect that same $60, instead of giving up the at the money, you know, that 240 strike in 4 days, to collect $60 in 18 days, you can get up to the 370 strike. Wow. So you get $130 more of upside for that same exact premium that you collect just with 14 days of difference there.
That's crazy, right?
It just, yeah, it doesn't, you know, make that intuitive sense that you're used to seeing in terms of how prices should be related.
Yeah. And, you know, I can just see it on the screen, but when you have this kind of volatility, you can see what's happened to the width of markets. I mean, they're monumental. You know, they're just so wide, monumentally wide, I should say. So the difference, what I mean by that is the difference between the bid and the offer is very, very large. So, you know, be careful, right? Is the bottom line. These are wide markets.
Wide and thin, you know, to your point, they're $4 and $5 wide and 7 up, 2 up, maybe 20 up would be, you know, a thick market here. It's definitely dicey, and, you know, for sure execution quality is really going to matter here. Trying to get in and out of
yeah, these are going to be wide, so be careful. I think our task today was to explain a little bit about how the short squeeze can happen, you know, what the dynamics are from the market making community when the snowball starts rolling down the hill, right, and how that can just kind of add fuel to the upward fire in this example.